Happy Thursday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. Let's jump in. And first up, the United States has imposed sweeping sanctions on Russia's two largest oil companies, Rosneft and Lukoil, in a bid to degrade President Vladimir Putin's war chest and bolster Washington's efforts to bring an end to the conflict in Ukraine. The move marks the first time the Trump administration has directly targeted Moscow's energy sector since Russia's full-scale invasion. Quote, "These are tremendous sanctions," end quote, President Donald Trump said on yesterday, adding, quote, "We hope that they won't be on for long. We hope that the war will be settled," end quote. Treasury Secretary Scott Bessent described the measures as a necessary response to Russia's refusal to end what he called a senseless war. Quote, "Given President Putin's refusal to end the senseless war, Treasury is sanctioning Russia's two largest oil companies that fund the Kremlin's war machine," end quote, Bessent said, adding that the United States was prepared to take further steps and urged allies to follow suit. The sanctions also apply to numerous Russian-based subsidiaries, majority owned by the two oil giants, effectively barring them from transactions in US dollars. Ukraine welcomed the move as a long-awaited show of resolve. Quote, "For the first time, Washington has decided to impose full blocking sanctions against Russian energy companies," end quote, said Ukraine's ambassador to Washington, adding, quote, "Peace is only possible through strength and by exerting pressure on the aggressor using all available international instruments," end quote. The announcement follows the UK's decision last week to sanction both oil majors and comes as the European Union prepares its 19th sanctions package against Moscow. The new EU measures will include a ban on Russian liquefied natural gas imports and additional restrictions on the so-called shadow fleet of tankers used to bypass existing penalties. Oil markets reacted swiftly, with crude prices climbing more than 4% on expectations of tighter Russian supplies. Quote, "This will further complicate oil exports by Russian companies, something we have already started to see after the UK sanctions," end quote, said an analyst at Energy Aspects. Rosneft, the world's second largest petroleum producer after Saudi Aramco, and Lukoil have faced mounting difficulties this year amid falling global prices and secondary tariffs on Indian buyers of Russian crude. Analysts said the latest US action could deter remaining customers in China and India, an outcome Trump has publicly demanded. The sanctions mean that all four of Russia's biggest oil producers now face US penalties. The former Biden administration had earlier targeted the third and fourth biggest, but refrained from expanding measures to avoid market disruption. Trump, increasingly frustrated with Putin over the ongoing conflict, said the decision, quote, "was time," end quote. His planned meeting with the Russian leader in Budapest was cancelled this week after a tense diplomatic exchange. Next up, we move to Europe. Yesterday, we learned that UK inflation held steady at 3.8% in September, offering Chancellor Rachel Reeves a rare piece of good news as she prepares a budget centred on easing the cost of living and reviving growth. The flat reading, against expectations of a rise, came as food prices eased, prompting traders to increase bets that the Bank of England could resume cutting interest rates before year-end. Reeves told the UK-based The Financial Times that her upcoming budget would focus on cutting household bills and creating room for further rate reductions. The relief follows months of strain on families' finances, reflected in this week's announcement of a 7% rise in the voluntary so-called real living wage. The Chancellor is likely to welcome the slowdown in food inflation. Still, Reeves faces a gaping fiscal shortfall estimated at £20 to £30 billion. Economists expect her to combine targeted tax rises with spending restraint. Tax partnerships used by high-earning professionals may face new levies akin to employer national insurance contributions, while online retailers such as Shein could lose a VAT value-added tax loophole that undercuts high street shops. In a bid to balance fairness with relief, she is also eyeing higher gambling duties alongside a possible cut in VAT on household energy bills. At an investment summit in Birmingham this week, Reeves unveiled a, quote, "blitz on business bureaucracy," end quote, promising to slash red tape and save firms £6 billion a year, a vital gesture amid rising profit warnings and weakening productivity. But government borrowing has reached a 5-year high, and the Office for Budget Responsibility recently downgraded productivity forecasts, underlying the limits of fiscal manoeuvring. One issue looks certain to re-emerge in Reeves's November 26th budget: Brexit. Both the OBR and the Bank of England governor have warned that the lingering drag from the UK's exit from the EU continues to weigh heavily on growth and the public finances. Adding to the complexity, a report from the Tony Blair Institute, published yesterday, urged the government to tamper its flagship 2030 clean energy target, arguing for a slower, cheaper path to decarbonisation to preserve public support during what is now very much a cost of living crisis. This is a rare acknowledgement from the political elite that these environmental policies are deeply unpopular and in some cases quite damaging to the wider general public. Quote, "We're in a cost of living crisis and a climate crisis. You can't just pick one," end quote, said the Institute's head. The report called for suspending some carbon taxes and capping offshore wind prices, warning that overly ambitious green deadlines could erode consensus on climate action. As Reeves crafts her first major budget, she must reconcile competing imperatives, restoring fiscal discipline, sustaining public confidence, and keeping Britain's green ambitions affordable, something they have not been so far to date. If you want to continue to be on top of the most up-to-date analysis on the biggest developments in the world's most important markets, consider subscribing to Market Update. If you're getting some value from today's episode, don't forget to hit the like button. And finally for today, we move to Asia. Japan's newly appointed Prime Minister, Takaichi, who made history on Tuesday of this week as the country's first female leader, has ordered a fresh package of economic measures aimed at easing the burden of inflation on households and companies while balancing fiscal responsibility. In her first major policy directive, Takaichi instructed ministers to compile a supplementary budget to fund measures that will likely include subsidies for winter electricity and gas costs and regional grants to help offset price pressures. The initiative also encourages small and medium-sized enterprises to raise wages and boost investment, reflecting Takaichi's goal of shifting inflation from cost-driven to demand-led growth. Finance Minister Satsuki Katayama said the extra budget would be sufficient in scale, emphasizing the government's intent to meet economic goals without committing to excessive borrowing. Cash handouts, a politically unpopular measure during the July election, was notably excluded. Takaichi has tempered her earlier support for aggressive stimulus, signaling a move toward what she calls expansionary but responsible fiscal policy. Her administration faces the delicate task of supporting growth while containing Japan's public debt, the highest among advanced economies, and managing the impact of rising long-term bond yields. Japan's growth strategy minister, tasked with assembling the package, stressed the importance of aligning fiscal and monetary policy. Quote, "It's important for the Bank of Japan and the government to move in tandem," end quote, he said, noting that the price stability and sustainable growth are key priorities. The measures come amid persistent inflation above the Bank of Japan's 2% target and a gradual tightening of monetary policy. The Bank of Japan's cautious rate hikes have pushed borrowing costs higher, raising concern over fiscal sustainability. Meanwhile, financial markets are watching closely. Analysts at Amundi Investment Institute expect 30-year Japanese government bond yields could rise above 3.5%, with continued uncertainty over Takaichi's spending plans and the Bank of Japan's broad reduction strategy. Quote, "There's a concern about fiscal discipline, especially in the medium term," end quote, said Charlie Huang, Amundi's senior macro strategist, who warned that investor confidence hinges on clearer policy direction. The package also seems to reflect Takaichi's focus on economic security, calling for greater investment in strategic industries such as AI and semiconductors, and stronger supply chains for critical goods. In parallel, Japan plans to move forward with a $550 billion investment scheme with the United States aimed at reducing tariffs and bolstering key sectors, a topic likely to feature prominently when US President Donald Trump visits Tokyo next week. As the yen continues to weaken, trading near 152 yen per dollar on Thursday, today, markets are bracing for further policy shifts. Whether Takaichi can restore confidence, tame inflation, and steer Japan's economy toward sustainable growth will define her early tenure and set the tone for a new era of Japanese politics. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Thursday, and I hope to see you for the next episode tomorrow.